Welcome back to the show. Let's talk to Tim Gregory, the Chief Investment Manager for Vermeer Investment Management. Morning to you, Tim.
Good morning.
Let's talk about valuations. You have a portfolio, you manage people's money. The markets are obviously one-way ticket at the moment. Is it easy to find value at this point in time?
It's not that easy to find value. And, if you think about just in the middle of the US results season, most companies, as is often the case, have beaten expectations. There have been some sensational results from last week from Apple had great numbers, and the week before Facebook, Amazon, Alphabet. So these tech giants are producing very good numbers, but they have gone up an enormous amount.
Yeah.
Optically, the valuations look stretched, but we're still in the situation at the moment whereby interest rates are very low, bond yields are very low, so investors continue to look around for what is an alternative to the slightly unattractive valuations that they pose. I think the markets could squeeze higher still, but there is a sense now that people are getting into the market for fear of missing out.
Yeah.
And that often happens quite late in the cycle of a bull market, and we have to be very careful about that now.
Well, look, in terms of being the top of the bull market, I was sitting on the train the other day and a couple was saying, oh, we're passive investors, we just put money in and it's straightforward, we always win, don't have to make any decisions, it's simple. And I'm thinking this is the top of the trade.
Well, that's often the case, isn't it? That when people become complacent and think it's a one-way ticket, that's when markets start to get more difficult. And I think what's been the sort of tail of this bull market since 2009 is for a very, very long time, because of all the concerns about not understanding how QE was going to unfold, and we still don't really know the answer to that, quite honestly, and the slow growth that we've seen and valuations being optically at slightly higher levels driven by lower bond yields. It's been a rather unloved bull market. You get a sense that that has somewhat come to an end now, and that people have joined the party and everybody now wants to belong. And as I say, actually, one of the things that's driving the market is the fear of missing out on something good. That quite often happens late on. So as I said, I think those are the sort of things. So my expectation is that maybe markets will continue to go up in the short term, propelled by the same sorts of cash drivers, and the fact that we're seeing good results and good growth, and there's the Trump tax plan, which is, if it's successful, could lower corporate taxes, and that could drive markets forward.
Yeah.
But in general, I would expect 2018 to be more difficult. And the more we go up in late 2017 and earlier 2018, the tougher it will be through the rest of 2018. Overall, I think 2018 might be a pretty flat year for the markets. Might start by going up, then we might have a correction, and then we might finish the year well. But overall, the sort of returns that we've had this year, which have been pretty fantastic, and of course last year as well, I would expect that to materially slow next year.
Tim, brilliant stuff. Thank you very much for your time.